Okay, let's go ahead then and begin. Our first topic this semester is going to be a kind of a broad overview of the Federal Reserve System. All right, so for those of you that are unfamiliar with the Fed, hopefully that's not too many of you, the Federal Reserve, or the Fed for short, actually, you guys know a way for me to, I don't want you all to see all this over here. Can I hide this somehow? How can I get rid of this? Hide thumbnail. Okay, is that better? Okay. So the Federal Reserve, or Fed for short, is the economic institution that, kind of broadly speaking, has performs three important tasks in our economy. One, and most importantly, is that it determines the course of monetary policy. Another thing that it does is that it ensures or oversees the health of the financial system. You guys know what the financial system is? What do we mean by the financial system? So my principal students should remember that. What is the financial system? Well, are banks, mutual funds, bond markets, stock markets, right? It's all those institutions in our economy that are really responsible for one thing: channeling resources away from people who are saving to those people who want to borrow for productive investment opportunities. The financial system moves dollars. It moves dollars from savers to investors, right? One of the Fed's goals or duties in the economy is to try to oversee or monitor the health of the financial system. They're also responsible for ensuring the health of our economy's payment systems. Now, we'll get into more of this in a minute, but the payment system is basically this kind of web of arrangements that we use in the economy to pay for everyday items: currency, debit cards, credit cards, etc. All of that stuff makes up the payment system. So as an institution, the Fed plays a critical role in the functioning of our economy. Now, the Fed is actually made up of several kind of complicated moving parts, okay? The three main moving parts in the Fed are: one, the Federal Reserve district banks, which I will hopefully be able to talk a little bit about today; two, the Board of Governors; and three, the Federal Open Market Committee, or the FOMC. The broad goal of this first section of the course is really just to try to look at how this gigantic monster is organized, how it's structured, and to see what the different roles and responsibilities are of these various components of the Federal Reserve System, okay? How they go about carrying out their tasks. In the coming weeks, we're going to look at in much more detail about how the Fed actually implements monetary policy in practice. What challenges does it face? What are the Fed's specific operating procedures? What are its broader macroeconomic goals? When the Fed makes a policy decision, how does that get transmitted to the rest of the economy? We'll get into the fine details of all that later in the semester, but to put all that in the proper context, I think it's helpful to review kind of the basic structure and organization of the Fed at the start of the semester. Okay, so that's the goal today. Now, for those two of you who had me in 113, you know I'm kind of a stickler for organization, okay? I like to be organized in my lectures. And so at the start of every topic, I'm going to put these learning objectives, and then I will refer to these numbers as we move through the slides. So the first thing we're going to do is look at the structure and functions of the district banks within the Fed. Then in the next class on Monday, we'll start talking about the Board of Governors, the Federal Open Market Committee, and then lastly, we'll talk about issues surrounding this concept of central bank independence. You guys know what that means? What do we mean when we say the central bank is independent? Independent from whom or what? The rest of the government, right? So the central bank of the United States, the Federal Reserve, has political independence from the rest of the federal government. That is the executive, or legislative branches of government, right? Not all central banks enjoy that independence. We'll talk at least somewhat about the pros and cons of whether or not central banks should have independence, right? This has recently come up a lot in the past year or so as the Federal Reserve's balance sheet has exploded and they've purchased more and more treasury debt. So this divider line between monetary policy and fiscal policy is continuing to be blurred, and it brings up issues of central bank independence. Okay. Few countries, and again, if any of this is confusing along the way, please raise your hand and ask a question. And for those folks that are remoting in, signal to me in some way. So few countries have as complex a structure for their central bank as the United States has for its Federal Reserve System. Now, it turns out that the Fed's organization was shaped by the same kind of political or constitutional philosophy that gave the United States government its divided powers, okay? So our US Constitution has all of these internal checks and balances so that one branch of government doesn't generate too much power at the expense of others, right? That same basic political philosophy was kind of embedded into the legislation which created the Federal Reserve. The Federal Reserve System, it turns out, has a lot of these internal checks and balances so that one economic constituency doesn't gain too much influence over others in the country. We'll talk more about that in a minute. I think to fully appreciate why the Federal Reserve is structured in the way it is today, it really helps to go back in history and look at some of our country's initial attempts to create a central bank. The Federal Reserve was not our first national central bank. We made two other attempts that failed pretty miserably, okay? Let me talk briefly about those. So in 1791, just a few years after the inception of our country, under the organization of then Treasury Secretary Alexander Hamilton, we all know who that is, Congress granted a federal charter for the Bank of the United States, or what then became what's called the First Bank of the U.S. Now, what was the main job of the First Bank of the U.S.? Essentially, its main job was to try to ensure financial stability throughout the country, okay? Now, how did it do this? The First Bank of the United States tried to keep the financial system stable essentially by limiting or discouraging somewhat regional commercial banks from extending too much credit, okay? Commercial banks are in the business of making loans, right? That's how they make a profit, is they loan money to investors at a high interest rate, okay? So banks want to try to loan as much as possible, right? But sometimes those loans go belly up, right? And banks take heavy losses, and if a lot of banks take heavy losses, the economy can go into a recession, right? We've seen several recessions in our history that have been caused by banking crises, all right? The First Bank of the United States tried to limit that financial instability by discouraging local banks from extending too much credit, all right? Now, how do you imagine that went over among the public? They hated it, right? You can imagine local farmers, business people, local merchants really wanted access to timely credit from their banks, right? And they very much resented a national central bank from kind of meddling in those local credit conditions, okay? And so the first national bank of the US was deeply unpopular among the people, okay? And as a result, it had hardly any congressional support, and after its 20-year charter expired, it was not renewed, and it ceased operations in 1811. So it was a pretty, all things considered, it had a pretty short lifespan and didn't accomplish much, okay? Now, if you guys remember your history, we had this War of 1812 right after the First Bank of the U.S. ceased operations. And it turns out that the US government had a very difficult time raising financing for that particular war without a national central bank. And so because of that, Congress granted a new charter for what became the second national bank of the United States in 1816, okay? But the second bank of the US was just as unpopular as the first bank, right? These efforts to try to stem excess credit at the local level was pretty unpopular, okay? And as a result, when its 20-year charter expired, it was not renewed. Now, there was a little bit of a difference. Congress, I believe, actually voted to renew or extend the charter of the second bank of the United States, but it was rather famously vetoed by Andrew Jackson, right? And so after 1936, there was no longer a U.S. central bank, right? Andrew Jackson, I think, was probably our first major populist president. He loathed the idea of a national central bank and a national currency. In fact, if you think about it, whoever or whatever committee was responsible for emblazoning Andrew Jackson's portrait on the $20 bill is not without a sense of irony, right? Among all the presidents that we've had, Andrew Jackson himself would have hated the idea that his picture was on the national currency, but it is what it is. Okay, so after the second bank of the United States ceased operations, we went through a long period in this country where we had no national central bank, a period of about 80 years, okay? Which means that we did not have what's called a lender of last resort. Now, that's a term you might hear me use a few times throughout the semester. What do I mean by a lender of last resort? So, a lender of last resort is where commercial banks go to get credit when they are in need of liquidity. So if a local commercial bank, let's say, is experiencing heavy withdrawals and can't access a loan from another bank, they can go to the central bank to access emergency credit, because the central bank is supposed to be the lender of last resort, all right? In the United States, we operated without a lender of last resort for some 80 years. And we went through this period where we had these recurring bank panics, 1873, 1884, 1893, and a severe one in 1907. You guys know what I mean by a bank panic? What is that? A banking panic or a bank run? That's where everybody tries to run and withdraw their money from their checking account simultaneously. Well, what's the problem with that? Banks don't, when you make a deposit into a bank, they don't keep all of it in reserve, right? They loan it out and make other investments. So if all of us go to the bank and try to withdraw at the same time, guess what? Those dollars aren't there. If that happens, then the bank needs to be able to get an emergency loan quickly, and they do so from the central bank. Well, we didn't have one for 80 years, and so we had this off again, on again bank panics, which created these pretty severe recessions. And the 1907 one was really bad. Many, many banks across the United States failed. The economy went into a deep recession. Congress finally said enough, and they passed the Federal Reserve Act of 1913, which established the Fed as our nation's central bank, okay? It was passed into law by Woodrow Wilson, and we've had the Federal Reserve as our central bank ever since, okay? So bear that in mind. The Federal Reserve, a central bank, is not mandated by the Constitution. No one in here has a right to a central bank. You all have freedom of speech. You all have the right to bear arms. You do not have the right to a Federal Reserve. That was created by an act of Congress. It can be taken away by an act of Congress if they want, okay? I think that would be a horrible idea, but I'm just saying there's no constitutional mandate for a central bank. Okay. Any questions so far? All good? All right, so the Federal Reserve Act of 1913 established the Federal Reserve System as our nation's central bank that we've had ever since. Now, most of the people, I would say, in Congress at the time when this legislation was drafted and passed had a similar kind of political philosophy, and that is they thought the idea of having a unified central bank based in Washington, D.C., that would concentrate power in the hands of a few economic officials would be a bad idea, right? We want to have divided powers and checks and balances within our central banking system. And so the Federal Reserve Act divided economic power in three particular ways, which I'll go into more detail here in a sec. First, it divided economic power among bankers and business interests, among states versus larger regions, and between the government and, believe it or not, the private sector, okay? The Federal Reserve is not a purely government entity. It is also a part private sector entity, which I'll get into here in a second. Okay, so the act and subsequent legislation then created actually four groups within the Federal Reserve System that were empowered to perform separate duties, okay? What are those four groups? The first, and if you think about it, the most important are these Federal Reserve District Banks. This is the arm of the Federal Reserve System that actually comes into contact with the public, okay? So it's really important. Private commercial banks are actually also part of the Federal Reserve System, right? When a private bank opens up and obtains a federal or a state charter, it automatically becomes a part of the Federal Reserve System. And then it has to abide by the guidelines and regulations of the Federal Reserve banking system as well. The third component of the Fed system is the Board of Governors. That's probably who you hear about most. They're located in Washington, D.C. And then lastly, we have the Federal Open Market Committee. This is a committee of select individuals that meets and decides on the actual conduct of monetary policy, which is just one of the things that the Fed is responsible for doing. Okay, let me make a few points here about the original intent of the Federal Reserve legislation. I think it's important for you guys to know this because it stands in pretty stark contrast to what the Federal Reserve actually is doing today, okay? The original intent of the Federal Reserve legislation was to delegate to the Fed control over a couple of things. One was the amount of currency outstanding in the economy. Essentially, what they're talking about there is the money supply, right? The Fed was charged with trying to control the money supply in an effort to keep the value of the currency stable. That is, prevent large inflations or large deflations. But the other and more important task involved was that the Fed was also supposed to control the volume of loans that it made to commercial banks. Maybe you guys have heard of these before. These are called discount loans, okay? This is the facility that banks use to obtain credit from the Federal Reserve through what's called the discount window. When a local bank like Regions Bank needs an emergency loan from the Fed, it goes to the discount window and takes out a discount loan. The interest rate that the Fed charges it is called the discount rate, okay? This is the lender of last resort function for the Federal Reserve. This is how liquidity is provided to banks in the United States. That was the original intent of the legislation. And the idea was that if the Fed was there to backstop all of this stuff at poorly performing banks, we could stop the spread of these kind of banking panics, right? If we all want to go and withdraw our money from the bank simultaneously because I'm afraid everybody else is going to do that, well, if I know there's a central bank that's there to provide credit to my bank, we're less likely to behave in that kind of panic fashion, right? So that lender of last resort function is what is in theory supposed to prevent banking panics. It doesn't always work. Okay. Any questions so far? No? That means you're either extremely bored or I'm just extremely clear in what I'm saying. Probably the former, right? Okay. As part of its plan then to divide powers more evenly across the Federal Reserve System, the Congress actually instead of creating a single central bank with just a bunch of branch banks, which, by the way, was the way the first and second national banks of the U.S. were set up, and that's the way that most central banks across the world are set up. There's a national bank and then just a bunch of branch banks beneath that. Congress elected not to do that in the U.S. Let me be clear, that's not the way our Federal Reserve System works, okay? What Congress actually did was they literally divided up the map of the United States into 12 separate, what they call Federal Reserve districts, okay? Each of these districts had its own central bank, all right? These have been come to know now as the Federal Reserve District Banks, right? So for example, we are in the Atlanta district. When a local bank needs a loan from the Fed, they do not go to the Federal Reserve Bank. They do not go to the Board of Governors in DC for a loan. They go to the Atlanta Federal Reserve District Bank for an emergency loan. This map here shows you how the country was divided in 1913 when the legislation was created. It has not been changed since then, right? You don't have to memorize all these, but Boston has a district bank. New York, that's an important one we'll talk about probably in the next class. Philadelphia, Richmond, Atlanta, St. Louis, Cleveland, Chicago, Minneapolis, Kansas City, Dallas, and San Francisco, okay? Each one of these Federal Reserve districts has their own district bank that they deal with. And by the way, each of those district banks themselves have several branches. So there's a branch of the Federal Reserve Bank of Atlanta in Birmingham, for example. There's one in Miami, as an example. Okay, now, obviously, if you take a look at this map, it looks pretty strange, right? You've got some of these districts are, they actually divide states into two different districts, right? So for example, you know, Mississippi or Tennessee or Louisiana are separated between districts, right? The one's in the Atlanta district, another one's in the St. Louis district, right? You've got economically dissimilar states that are sometimes grouped in the same district, right? Like Michigan and Iowa, right? Where there's a heavy manufacturing base in one versus a heavy agricultural base in the other, okay? At the time the legislation was created, each of these 12 districts had a pretty nice mix of urban versus rural, of agriculture versus manufacturing versus commerce, okay? All of this, let me make this very clear, all of this was intentional. This arrangement was designed on purpose. And why is that? Because Congress wanted to prevent any one economic constituency, like a big banking conglomerate or a big manufacturing base, to be able to exploit its power to obtain preferential treatment from the Federal Reserve System. It tried to divide that economic power more evenly across the country. On the slides there, that map I think is interactive. The last time I checked, I think if you click on any of those districts, it will take you to, for instance, the Federal Reserve Bank of Atlanta's website, etc. Okay. In the time remaining that I have in class today, which is not very long, let me start by talking about kind of the basic structure of a typical Federal Reserve district bank. So we're going to focus on the district banks for the last 10 minutes or so and probably into the beginning of class on Monday. Formally, each of these 12 district banks is actually a separate corporation. Let me repeat that. Each district bank is not so much a government entity as it is a corporation, okay? And as a corporation, it's governed by a board of directors, and it has equity shares to outstanding parties, okay? So let's be perfectly clear about this. Who is it that owns these Federal Reserve District banks? They're not owned by Washington, D.C. They are actually owned by the private commercial banks that elect to join the Federal Reserve System, all right? When a bank opens up and it obtains a federal or a state charter, which the vast majority do, hopefully that won't happen too much. They're actually required to purchase stock in their district Federal Reserve Bank. Okay, so those commercial banks are the ones who actually own the Federal Reserve district banks. Okay. Now, just like any other, why is this not working? There we go. Just like any other stock owner, then, these commercial banks can receive dividends from ownership of those equity shares, right? So when a local bank enters into the Federal Reserve System, it purchases an amount of stock from its Federal Reserve District Bank, and it receives annual or quarterly dividend payments based on ownership of that stock, which I believe is something like 6% of the value of the shares. Now that number has stayed the same for many years, but I think in recent years, Congress has tried to dip into this source of money and tried to pass legislation that would lower these dividend payments back to commercial banks. But the Fed has been able to prevent that from happening. Okay. I should say, however, that the Federal Reserve District banks aren't purely like other private corporations in the sense that the stockholders here don't have all the same rights and privileges that stockholders would have of other publicly traded companies, right? What's your name? James? Jameson. Let's say he owns 1,000 shares of Facebook or 100,000 shares of Facebook. You could potentially vote on things like the board of directors for Facebook and whatnot, right? And have voting rights. You could use your Facebook shares to as collateral for another loan, right? The commercial banks can't do that. You know, Regions Bank can't take its shares of the Federal Reserve Bank of Atlanta and use it as collateral to obtain another loan. So it can't do that. So the better way to think about this is that each of these district banks is not a purely private entity. It's not a purely government entity. It's more like a joint private public venture, okay? But that's important to understand. It's not fully government, but it's not fully private sector either. Who is it that governs? This will be the last thing I talk about today. Who is it that actually governs the Federal Reserve District banks? Well, it's a corporation, right? So it's governed by a board of directors, just like any other corporation. The only difference is that the composition of the Board of Governors is regulated by the Federal Reserve Act legislation, okay? The idea here, again, in the creation of the Federal Reserve System was to try to prevent one constituency from exploiting the central bank's power at the expense of another. And so another way that Congress tried to establish this or enshrine this into the law was by restricting the composition of these boards of directors, okay? This is a little bit detailed, but I think it's important to know. Each district bank has a 9-member board of directors, okay? 3 Class A directors, 3 Class B directors, and 3 what are called Class C directors. Now, who are the Class A directors? These come from the banking interests within the district. So all of the private commercial banks that are in the system elect, within a district, elect 3 individuals from the banking industry to be on the board of directors of the district Federal Reserve Bank. They represent the interests of banks. Obviously, we need to represent those interests within the Federal Reserve System, the banks playing a crucial role. But all 9 of these board members are not bankers, okay? The Class B directors come from the business or commerce sector outside of banking, okay? Class B directors are also elected by the private commercial member banks within the district, okay? This just reminded me. You guys have heard of Herman Cain. He just died maybe a few weeks ago. He ran for president 4 or 8 years ago. I don't remember. On the Republican side, I think he was the CEO of some pizza company. But during his career, he also served as a Class B director for, I think, the Federal Reserve Bank of Atlanta. So it's folks like that who from time to time will serve on the board of directors of these district banks. How about the Class C directors? Where do they come from? These are individuals that are supposed to reflect the interests of the general public. So labor leaders, maybe local politicians, or whatnot. These are folks that don't necessarily represent the interests of banks or other businesses or industries, but represent kind of the general public. Unlike Class A and B directors, Class C directors are appointed by the Board of Governors. All right, so the individual banks in the Federal Reserve districts have only a limited ability to influence the composition of the Board of Directors. Some of those board members, the Class C directors, are appointed by the Board of Governors in Washington, D.C. Okay. I think this is probably a good stopping point. So what we're going to start with on Monday is talk about the actual roles and responsibilities of the district banks, what they actually are doing in our economy, and then we'll move on to discuss the functions of the Board of Governors as well as the FOMC. All right, all of this stuff is not super technical, but again, it's good background information on how the Fed is structured so that our more detailed conversations about how the Fed actually does things like monetary policy later in the semester can all be placed in the right context, okay? If y'all have any questions, that'll be it, and I'll see you guys on Monday. And again, I would much prefer you come face-to-face rather than remotely, okay? Have a good weekend.